This is the third and last in the series of recordings dealing with the IRBA's Public Inspections Report of 2017. In the first recording, we dealt with the background and overview. We dealt with the remedial action process and the sanctions and future outlook. In the second recording, we dealt with the firm inspections, and this one we will look at engagement inspections. So just to set the context, when IRBA reviews a firm, they look at the firm first, so everything to do with the firm as a whole, and then they look at specific engagements. So when they look at the firm as a whole, these are the aspects that they look at and that we have covered in the previous recording. Leadership responsibilities, that's a so-called tone at the top. Ethical responsibilities, we touched on acceptance and continuance of client relationship and engagements. Then also engagement performance and internal quality reviews. There they look at two things, or they mention two things specifically: engagement quality control review and file tampering. 6 is monitoring, the firm's internal monitoring process of its own quality. And then lastly, they also inserted an element dealing with reportable irregularities. Today we're going to look at engagement inspections. That's the aspect dealing with specific findings that they had on specific engagements. And there's a couple of them. One is under revenue. They still have some recurring problems there. They found a lot of areas, or some areas, that relate to the risk assessment. We do a risk assessment, and then we do procedures, but the procedures don't necessarily agree with the risk assessment that we did. Also, remember that in terms of ISA 240, there is a presumed fraud risk in revenue recognition, and that fraud risk can be rebutted, but that is in exceptional circumstances. It would appear that some firms just rebut it as a default, and that's clearly not accepted because it has to, as I said, be in exceptional circumstances. Also, an issue where auditors do not show that they have assessed the internal control environment and performed walkthroughs. Remember, because revenue is a significant risk, you have to do these steps: assess the control environment and do walkthroughs. Then still an issue as far as completeness of revenue is concerned. People are testing completeness or testing revenue only from one direction or from the wrong origin. When you test completeness, you should test from the origin of the transaction. And that is commonly something that is outside the system. So you would test it from a delivery book or something, orders from the client or something like that. Typically not something that is produced by your accounting system, although sometimes it can happen. And then when we concentrate on completeness, we find that we neglect the other side, which is the occurrence of the revenue. Make sure that you test, basically for revenue, you should test in two directions. You should test completeness, and then that's from the origin to the end of the transaction, and then you should test from the other side, from the trial balance or general ledger back to the origin of the transaction, and that would give you the occurrence and completeness and validity and all sorts of other things like that. Also, while we are on revenue, found that some events were improperly classified as revenue. Be careful what you classified as revenue. If it's a recovery from the client or discounts, the financial reporting framework would tell you how to deal with those things, and make sure you do that properly. The second element on the file inspections is significant estimates and judgments. That is becoming a big area. I think almost any auditing area, any accounting statement that you deal with these days has got an element of estimates and judgments involved. And we have to, be skepticism, especially if let's say the client has prepared an estimate for you. You have to go and audit that. You have to question the assumptions specifically, the assumptions that the client used and the judgments that they applied in doing that estimate. Even if it is done by a so-called expert, if the client employed an expert to do it, so let's say a valuation expert or someone like that, you still have to be skeptical about their assumptions and about their methodology. And you have to document that you were skeptical and that you actually did think about how they did it and that you verified it or assessed it. Also, the last point here on property, plant and equipment, that's an old one. We have to keep on assessing useful life and residual value, especially in the case of IFRS 16. We need to make sure that management has continuously assessed, or on an annual basis, assessed the useful lives and residual values of their assets. And the IFRS for SMEs, it's a little bit easier. That's only if circumstances change, but there is still an element of assessment involved, and that's important that that is done, and it's done consistently and correctly. Consider componentization. If an asset has separate components that depreciate in different patterns, then we obviously have to look at that, and it seems like people don't necessarily look at that consistently. A further issue is loans to and from related parties. Check on the valuation of these loans. Obviously, the valuation is a very important issue if it's material. Impairment of trade receivables, that's an old one. Make sure that debtors are recoverable. If not, an impairment should be raised. Impairment provision should be raised. Then, insofar as business acquisitions are concerned, if a business is purchased, you must make sure that you document all the assessments. And often we are involved even in the negotiating stage, so we know what the agreement is going to be about. But we must make sure that we document all of that. For example, did the acquirer buy the business, or did they buy the assets? The purchase price allocation, was that done correctly? I think they meant here purchase price allocation, not purchase price acquisition. Very important. The purchase price has to be allocated. You can't just, if goodwill is in the books of the business that is being acquired, just transfer it. The purchase price has to be allocated properly in terms of the accounting standards. Deferred tax assets. A deferred tax asset, especially if it's related to an assessed loss, we need to have good, proper supporting evidence to show that that asset is actually going to be recovered. Otherwise, it has to be impaired or maybe not recognized at all. Specifically in the current economic environment, we know that it's not easy with most businesses. So we have to be a little bit more careful when we do the going concern assessment and all of these estimates that relate to going concern, that relate to the continued profitability of the business or business lines. We have to be a little bit more careful than we were in the past, because businesses that were successful in the past may be under strain at the moment, and some of them may fail. And we have to be very careful when we look at which ones are healthy and which ones are not. There's a brief mention in the report on the anticipated revisions to ISA 540. That has now been approved. ISA 540 is the one that deals with estimates and judgments. We've still got the best part of 2 years before it has to be implemented, but there are some changes coming as far as estimates and judgments are concerned, so just look out for it. Some of the basic auditing principles are reported again in this report. Numerous instances where the reason for concluding a risk rating of significant or normal, the reasoning was not documented properly. Things to do with assessment of accounting risk has to be, risk has to be assessed at all levels for account balances, classes of transactions and disclosures at the assertion level. So at the lowest level, the risk must be assessed. Risk relating to fraud risk in related parties, management override of controls and revenue is normally presumed significant. There's obviously conditions, and one of those can be rebutted, but remember that those risks need to be documented in the file, always, related to some related party transactions, management override of controls and revenue, which we have mentioned already. Materiality, still the old thing where people don't document the basis for materiality sufficiently. Remember to look at who the users are of the financial statements, and that's how you should base your materiality. Audit sampling, many issues related to sampling, inconsistent sample sizes not in line with the firm's methodology. Remember, they're unlikely to question your methodology if you have a statistically sound methodology. But what is going to be questioned is if you don't apply your firm's methodology, then obviously obviously something is wrong somewhere, and you can expect some questions on your sampling side of things. Documentation does not always show that we have assessed working papers and representations prepared by the client. Client gives you something, a working paper or something, we have to assess it, we have to verify it, we can't just rely on it. Inappropriate source documents, we mentioned already where sales is being tested, where is it tested from? That could be something outside the system or system produced. We have to make sure that the right source document is used for the right place. Lastly, there are also some cases where the lead schedules did not agree to the financial statements, or disclosures do not agree to the financial statements. Make sure that the set of financial statements, the signed financial statements that you've got in your file, that it is actually agreed to the lead schedules in your audit file. It's important that it shows that that is actually the set of financial statements that you have audited. And then all of this is about documentation. IRBA still applies the principle of if it is not documented, it is deemed not done. So make sure that everything important is documented and it's shown in the file. Still the same problem in the working papers, where when IRBA questions us, we use another section in the working papers in the audit file to support a specific section. And the issue here is that that section might be there by accident. If you didn't consider it properly, then IRBA, or show that you considered it properly in the context of the specific section, then IRBA might not accept those procedures as procedures that support your audit evidence. Then there's other issues relating to the completion part of the audit, the finalization stage. I want to mention here potential errors. That's your overs and unders. We have to consider the qualitative impact. That's why we have to record all the overs and unders. Obviously, unless it's trivial, we have to record them, and you have to assess their impact, and not just the quantity, the quantitative impact, but also qualitatively. If they all appear to be going in the same direction, then there's clearly an issue. They have found some issues where the work wasn't properly reviewed by the engagement partner, specifically the completion stage. And then some issues where the final management rep letter was never signed by management or was signed too late. Same with the subsequent events and going concern. Make sure that the date is shortly before the date of the auditor's report. There shouldn't be a big space between subsequent events and going concern assessment, and certainly it should never be done after the date of the audit report. Then that obviously just doesn't make sense. Then also a lot of issues relating to disclosure in the financial statements. A restatement of a prior year. You can't just go and change prior year. You have to consider if it's a correction of an error or if it's a new accounting policy or something like that. If it is a correction of an error, it needs to be dealt with appropriately in terms of if it's IFRS, IAS 8 and IAS 1 appropriately. The IFRS 7 disclosures, there's a lot of disclosures in terms of IFRS 7, and IFRS 13 goes together with this. Make sure that those disclosures are made. That's to do with risk and risk management and so on. But not only must they be made, they must also be audited. So you can't say that the client has a policy of preparing budgets and that's how they manage their liquidity risk if there aren't any budgets. We must make sure that we audit it and that audit work is documented in the file. IFRS 13 fair value hierarchy requires a few disclosures for level 2 and level 3 instruments, and we must make sure that that is there. In impairment assessment of goodwill, there's some items that have to be, in terms of IAS 36, have to be disclosed. It's quite extensive disclosure in terms of the impairment assessments. So go and look carefully at IAS 36 paragraph 134 to make sure that that is all covered. Directors' remuneration, this is a minefield, specifically in terms of the Companies Act, in terms of IFRS as well, because directors are a related party. But in the Companies Act in South Africa, there's requirements that deal with directors' remuneration. Directors' remuneration has to be disclosed in certain instances, and in some instances per director. Not good enough to just say A, B, C, D, E. And also, you have to show directors' remuneration that was paid by the group for the company's director. If the group paid, not the company, but the group paid a company's director a remuneration or something, that should be disclosed. And make sure that is covered. Look carefully at those sections. The distinction between current and non-current is still a problem, specifically regards liabilities. In fact, even assets. We have to consider very carefully, specifically intercompany liabilities and assets, whether they belong where they are, if they are still current or non-current. And those areas have to be documented very carefully. In terms of other areas, journals, still a problem. Obviously, journals are very high risk because with a journal you can change anything, you can conceal an error, you can conceal fraud. So a journal is very important. We have to do a proper risk assessment and we have to show that we did sufficient work on journal entries and other adjustments. You can have a look at the IRBA and SAICA frequently asked questions. That will give you an idea also about the extent of testing. It seems like there is some consensus now at least on that. Cost of sales, can't only do analytical procedures, you must do more work, and you must also carefully look at the distinction between cost of sales and operating expenses, other operating expenses. Goodwill should be tested. Remember the lowest cash generating unit level. Related party transactions continue to represent a significant risk area. In terms of the standards, if a related party transaction is large, significant is the word, and it's outside the ordinary course of business, then that is a presumed risk. So we need to look at that. That needs to be covered and dealt with as a significant risk. Then a couple of issues on the audit report itself. Obviously there we have to be more careful than careful because we have to make sure that that part of the file is absolutely correct. There are still some findings, for example, where the audit report incorrectly refers to the wrong framework. So IFRS was used, but the report refers to IFRS for SMEs. Obviously, normally just an administrative error, but that's not the sort of error that we should allow to go through. Consolidated financial statements. We have an audit report saying that the financial statements are the group statements, it's not consolidated. Or where consolidated financial statements are simply not prepared. That is obviously a big problem because it's a contravention of the Companies Act, it's applying the wrong framework, and we have to deal with that. That's a big problem. Signatures, there's a bit of a problem there in the sense that the auditors don't seem to identify exactly when they sign an audit report which set of financial statements it relates to. Make sure that your audit report is clearly attached to the final set of financial statements that goes out. After all the adjustments and revisions and reviews and all of that, eventually you're going to sign one audit report. It's going to be attached to one final set of financial statements, and make sure that that final set of financial statements is the one that is in the file. Cash flow statement. Be careful that what is in the cash flow statement is actually cash flow only. Look at it line by line. We can't just look at the difference between this year and last year and report the difference as a cash flow. Some of those items include non-cash items that should be adjusted for. I talked about the consolidation exemption. There's very few areas where we can actually use the exemption, and most of the times if there's a group relationship it has to be consolidated. Not consolidating it is a big problem, and that is normally going to result in an adverse opinion. Trust accounts, attorney's trust accounts, still a high risk. There's still a lot of issues there. Probably getting better, but there's still a lot of issues, and you can know that IRBA is going to concentrate on those aspects. Okay, so that was the summary of the inspection findings of 2017 as far as it relates to the file inspections, engagements inspections. That is not the firm as